So we're going to look at not just tariffs, but we're going to look at how a more protectionist world, so things like market access barriers, regulation changes, how this is influencing venture capital, scaling strategies, and where innovation gets built. So before we dive in, I'm going to ask my panelists to tell us a bit more about themselves. Div, why don't we start with you?
Sure. Hi, I'm Div. I have been a serial tech entrepreneur. I built and sold 3 different companies, and I'm running the 4th one, which is Ai.tech. Additionally, I've been running the family office for the last 17, 18 years.
Alex?
Pleasure to be here with you all. My name is Alex Lazarow. I run a venture fund called Fluent Ventures. We invest globally in early stage opportunities. Wrote a book a couple years ago called Out-Innovate, how global entrepreneurs from Delhi, Detroit are rewriting the rules of Silicon Valley. Excited to have a conversation.
Thank you so much. All right, well, let's dive in. So first of all, I'd like to know from both of you, how is geopolitical uncertainty, and like I said, not just tariffs, but broadly fragmentation of the global economy, how is that shaping venture capital investing nowadays? Alex, do you want to kick us off?
Yeah, happy to. I will say a startup is not a company. A startup is a project in search of a business model. And at the earliest stages where I invest, the biggest risks are, do the founders get a divorce? Do they find a product that people want to buy? Like, does the market even exist? And I hope that one day I have the luxury of having an investment in a company that is so big that it actually, tariffs hurt it, et cetera. And so I actually think for the early stage it's less an issue. However, I actually think it's creating some really interesting distortions. If you think back 20 years ago, most technology companies came from Silicon Valley and tried to go global, and we have a whole set of those. Today, I think the biggest technology companies are local and regional, and I think tariffs are, we dive in more on this, but I think tariffs are part of a trend of actually seeing more fractionalization or localization of big ideas, and so I think we're going to see more of that.
Thanks. Div?
I'd say that the world in the last decade, until recently, used to be flat. We always spoke about a flat world. You build in Bangalore, you sell in Boston, you exit to a company in Beijing. That has changed. In a flat world, you optimize for efficiency. So where can I get it the cheapest and the fastest? In a fragmented world, you optimize for resilience, and you think about how you want to construct that resilience. As far as protectionism is concerned, when I was younger, I was more of a purist. So if you asked me, what do you think of protectionism? I'd be like, that's the most stupid thing ever. Today, I think I'd say strategic protectionism is very vital for countries, and it needs to be part of their planning. It's the only way to make sure that they're holding lesser risk in the long run. That's how I think of it.
Do you think, in a way, you've kind of alluded to this, but there's opportunity in all this fragmentation, right? Like, do you have any examples of maybe startups that you've backed or things like that that have actually capitalized on this?
Yeah, this has actually been one investment theme for us, which is that, specifically like tariffs as an example, have created a need for a lot of suppliers, buyers, to think about resilience in their supply chains. And so, for instance, in India, among the top 10 unicorns, 4 basically have become B2B marketplaces that actually help solve supply chain constraints, many of which around China plus 1. I've seen that model emerge and evolve in a bunch of different places. I'm an investor, for instance, in a company in the region here, which is replicating that model for the Middle East, so B2B marketplace around construction. Those types of things are catalyzed in part by fragmentation and challenges geopolitically.
I think all change is incredibly helpful to founders. And smaller companies are more nimble than larger companies. The advantage of any change in tariffs, obviously, and the way the world is moving is a big change. The advantage is it shakes the status quo and you find opportunity in it. I think companies should still, even whether we talk about tariffs or you talk about non-tariff barriers that you spoke about, I think startups and companies still continue to need to have a global ambition, but you optimize for local scenarios. So how you would construct building a company a few years ago is different than how you would do it now. Now it's more about, hey, you need to figure out a backup plan at any point of time as to how do I move my IP, how do I move my people, how do I move money, how do I build the product such that if there is change noise, by that I mean trade noise where things are not consistent but they change, how do you build for that into your business plan and into your management really, because it's more around keeping that management that you've built ready for different kind of change scenarios. And they don't need to be detailed plans, they just need to be one-pagers. But the idea is the more you do that, whenever some change happens, and these days changes happen often, and you asked how has it been positive. I'll give you a couple of examples. I know a founder friend that basically runs this Canadian shipping company. They ship products into the US. Because of all the tariff craziness, the rules keep changing. And so the need for small businesses to use some platform increases, and hence their margins have increased materially this year. I'd say that if you think of it from a more macro perspective also, if you look at post-COVID, all prices for hotels and airlines uniformly increased, and then they never went down. The same thing happens with tariffs. When you layer a tariff onto any market, prices go up. When the tariffs change or get optimized downwards, prices don't change, margins increase, and eventually the cost kind of bulks up into it at some point or bloats up into it. And you as a business owner hopefully want to optimize that bloat. But I think that change is very positive for businesses that are used to being nimble.
Mm-hmm. Okay. So we kind of talked about it, but like in your view, what's more problematic for a late stage startup, a tariff barrier or non-tariff barriers?
What do you think?
Sure, a non-tariff barrier. I mean, a tariff is just margin, right? So essentially, as soon as you basically have a tariff in place, there's a margin, and the margin question is just solved by a pricing math, and then you might temporarily not have the gross margin to do it, and you optimize to that. And then everybody faces the same tariff, so you don't really have that problem. In a non-tariff barrier, and let me give you examples, it's about what industries are you allowed to play in, what do you have access to. Those are, that's not solved by margin, that just kills the business, or kills the industry, or kills the marketplace. It basically means that you have to figure out how to set up locally because there's no getting around a non-tariff barrier.
Mm-hmm. So actually, I was thinking maybe software would be more, when you think about tariffs and protectionism, software companies would be more advantaged than like
it depends on whether it relies on hardware or not, right?
Mm-hmm.
So for example, I mean, if you basically take the whole chips situation, obviously for very strategic reasons, the US has, tried to slow down progress elsewhere by ensuring that their software or software that's not built in the US doesn't get access to those chips. And that's very smart. Mm-hmm. So I don't think that was wrong in any form, but essentially it could impact software also. Now software is more resilient, but essentially changes the buyers, for example. So if you're building, let's say, something strategic in any country, whether it's the US or it's Europe, whether it's China, whether it's Middle East, if you're restricting the number of buyers that can buy that software in some form or buy your company in some form, it changes the dynamics in terms of the total demand supply. Mm-hmm. And so there would be restrictions there. So I think they can all be worked around in the sense that it just means that sometimes people want your data to be local, sometimes people want your local regulation to apply, and they want a team locally. And so it means that you need to change the way you did business, but obviously you can optimize to it in software a lot more easier than in hardware.
Mm-hmm. My sense on that, by the way, just building on that comment, is in some ways software versus hardware is not, to me, the most important dichotomy. In some ways, it's like the nature of the business model. And so, does the thing have local network effects? How complex is the operations and the supply chain interdependencies? what are the regulatory impacts? And those, I think, determine in many ways like how tariff or other geopolitical barriers drive the impact on the company. And you can have that in a hardware and a software business, or not at all.
I'd like to talk about capital raising now, valuations. What impact are you seeing from all this fragmentation? Like, are you pricing a discount for supply chain risk, or like, is it affecting the size of funding rounds? We've talked about in emerging markets, like currency risk potentially, fluctuating dollar. Are you seeing any impact, Alex?
My sense on valuations and also availability of capital, it's a little bit like a fulcrum, where if you are an AI company in Silicon Valley doing like the next hot thing, and like right now it's really hot, it's like super big impact on valuation, and we're a little bit, frankly, back to 2021 in terms of multiples and mania. But if you're kind of like not...
Or even crazier, right? I mean, like you could be a 10-people company with no business plan and raise $1 billion or $10 billion in valuation. You're like, what is that?
By the way, there's like an insane data point that came out last week, which is that 40% of Silicon Valley rounds before, like Series A and before, are over $100 million, which is absurd. But I think in emerging markets, I think capital is really like what has gone to Silicon Valley and AI is actually pulled out from a lot of other kind of styles of companies. And so, yeah, I think geopolitics and tariffs and all that is like part of it. And I think it just amidst a much broader story, but 100%.
So I wouldn't call it absolutely absurd in terms of having $100 million seed rounds in terms of valuation. The reason for that, and I'll get to it, is about risk management, right? I mean, like today, the VC funnel has had more money in terms of pools of capital raised to invest behind opportunities than ever before. I think the 100 million represents not the value of the business at that single point of time. It represents the value of the fact that you can now build a business that can grow very rapidly into a multi-billion-dollar business, and so you're basically playing that math. And then you're hopefully, you still want the numbers to work. So if you're making 10 bets, you still want 2 bets to outperform, and you still want 4 or 5 bets to basically make sure that they return the money and then some, and then 2 or 3 will fail. So as long as it fits that math, and sometimes obviously it becomes absurd in the sense that you're taking too much risk and sometimes you're taking too little risk, and that cycles. And it's very hard for, hindsight's 2020. If you tell me today that, it's absurd, I'll be like, maybe. I mean, I would have said that when YouTube was bought by Google for $1 billion, or when Mark bought Instagram for $1 billion, which was like a tiny company at that point of time, I would have said that was absurd. Like maybe today they don't look absurd at all.
They are actually incredible deals.
They look like the best deals ever done.
I will say on that point, like the venture capital firm model has shifted over the last 5-7 years, where you have the phenomenon of the much larger multi-stage firm whose business is like placing large amounts of capital. And so I think on the one hand, and I think on the other hand, I think one of the things that's interesting about AI is we're seeing very, very rapid growth, like faster than I think at any other point in technology of getting to milestones for Series A and B. And also I think it's possible to build companies way more capital efficiently today. Yeah. And so you get to a product very early.
And that creates that uncertainty also that we were speaking about earlier, right? Like how do you price some things? For example, if you look at the stock market in the last week, around Claude launching that legal plugin, it's basically, it crashed so many companies in terms of market valuation because people don't know how to price many of these things. And frankly, I don't think anybody does. So it's everybody's best guess. And the first person that starts moving a lot of money, everybody's like, oh my God, maybe I'm missing out, let me sell. Or, oh my God, I'm missing out, let me buy. And so it's, I think it's really hard for people to know where things are going to go. All we know is there's massive change taking place. This thing is going to be in everything. Everybody needs to adopt it. Who the winners are going to be is hard to figure out. Unlike the search game where there was literally one winner, which is Google, and then maybe a second close one with Microsoft, which is actually not far apart, but a second one sort of. With AI, I think it's going to be like subscriptions, right? I mean, like today you buy your Apple TV subscription, you buy a Netflix, you buy a Hulu, you buy HBO, you buy Paramount, you buy Disney Plus, you buy Peacock, because your favorite show's on it. I think models are going to go in the same way. I think the top 5 or 6 companies are going to buy all of them. And they'll all specialize in something because that's where they spend time and resources. And time will tell if everybody will equalize, but in the large language models, everybody seems equal enough for most tasks, and then specialize for certain other tasks, and you got to navigate that.
Well, yeah, I think unlike Google and Facebook, to your point, I don't think there's economies of scale or there's not or network effects in the same way. But I think there's going to be economies of capital, where a narrow set of companies are going to get the capital required, or they're going to go open source.
Less than 10.
Yeah, I actually think it'll be less than 5. Like I actually think a lot of the like tier 2 models are going to struggle raising capital, and the burns are really.
Or they're going to get bought out by the top 5, right? I mean, eventually.
Probably, yeah. That's fair.
Or the talent gets bought out, if not the company itself.
Yeah.
Okay, so you mentioned how the venture capital firms are changing. I'm curious now, with this geopolitical shift, like, do you guys see venture becoming more global or regional?
I think we're going to see a mix of both at different ends of the market. I think at the early stage, there's already been an explosion of early stage funds. When I started investing in 2013, 4 cities have created a unicorn. Today, that's 260. And so with that, there are like local talent hubs and lots of venture capital firms getting built everywhere. I think that's going to continue, and I think I did an analysis.
I agree. I mean, at the end of the day, venture at the venture stage is always a lot more local, because venture stage is about relationships and identifying talent. It's harder to do remotely, and because again there are a whole bunch of rules around investing in many different countries. So I think venture will, at the venture stage, it's going to be more local than global, and it's not different today. It's always been the case. All Alex means now is there's a lot more venture opportunity locally than there used to be, because most companies used to be in a handful of countries, cities. Now they're in a lot more cities, and so there's a lot more opportunity locally. But late stage, by the time that you get to public stages and stuff like that, then it gets a lot more global.
Okay. And do you see, like in the past 12, 18 months, like geopolitical risk, is it creating a localization of winners? Like, are you seeing in the companies that you're backing, like business models that are succeeding on a regional more rather than a global basis?
I mean, that's by design, right? At the end of the day, the reason that those regulations are being put into place is because countries want local champions. And so by design, they're trying to give them an advantage, and I don't think that's wrong. By design, they're realizing, all these countries, that there are a handful of companies in the world that essentially are capturing or competing with their local champions or local old businesses, which is moving capital in a form that they don't like. And so they're building strategic rules to figure out how best to handle. Some of them are silly and they'll change. Some of them are smarter and they will stay, just like anything else.
I also believe that there are not that many business models that are capable of generating $1 billion revenue, like a massive outcome. If you look in emerging markets, the number one tech company in any market around the world is the same. It's a local version of Amazon. The number 2, number 10 in almost every emerging markets is the same. It's a digital bank, it's a buy now, pay later, it's a local version of Uber, whatever. I think that's part of the reason, is that we're going to see local winners because they're going to execute local versions and local adaptations and reinventions, but solving really, really big universal problems that exist in different places.
It used to be local industries, right? At the end of the day, all you're saying is, when you take any economy, in the economy, there are certain sectors that are large and they're massive, and so you'll have telecom, you'll have power, you'll have some sort of energy, you'll have retail, you'll have manufacturing, whatever, right? And so the new version of it and the digitized version is the digitized version of it. And so temporarily, the global giants used to be able to do a lot more because markets were fully open. And now the global giants need to basically invest locally or increase their investment locally. And they have the dollars, so they do it. They're sitting on tens of billions of dollars in cash. So you have some combination of, and to your point, in Turkey, Trendyol might be like really big because obviously it's a local version of Amazon. In India, basically, Zomato, Flipkart, whatever version of the local version would be big. But at the same time, you still have the global giants playing alongside. So you kind of have both.
Although it's increasingly, I would say, like in the generation of companies that were founded 20 years ago, there's more and more of the global champions. Today, increasingly, the local champion has won, and like Uber's a really interesting case study. Like Uber started in Silicon Valley. In all the markets they entered before a local company existed, they kind of won. They're like the dominant player of LATAM. In all the markets that were like wave 2, it was a local winner that won all of those. And so I actually think there's a real
And
advantage there.
then Uber went out and bought a bunch of them, right?
And they definitely
acquired Kareem, right?
Yeah. Economies of capital to the point earlier.
Economies of capital, and also, I mean, to your earlier point, software translates. So it's a lot easier to localize good software. And so you can bring economies not just from a capital standpoint, but also from a business process standpoint, and that basically helps. But it does allow local champions to get to a size and stage, and either they can keep growing, or somebody goes and buys them, or they're prevented from any of it, and so basically they have no choice but to keep growing, right? Because in certain countries you're not allowed to sell, and that's a country by country decision.
Okay. I do want to talk about exit environments. So obviously tariff headlines or any sort of geopolitical headline had a huge impact in April last year. Since then it's been more sporadic, but there's constantly headlines. However, we're about to see potentially the largest IPO ever in SpaceX. So I'm wondering, do you see an impact on this, Div?
So obviously exits have been challenging at different stages. More recently, and you can see that in the PE fund exits that have, more PE funds and VC funds have had to hold on to companies for much longer. Initially because they wanted to, because they wanted to capture a lot more value, and then later because they were forced to, because there were not as many exit opportunities at the price point or the NAV that they pegged the asset at. And so obviously exit opportunities existed, but they didn't want to exit at a valuation that the market was giving them, right? So the market's giving you valuation every day. You may, if you don't like it, you're just going to hold on to it if you can. I think uncertainty obviously affects pricing, and uncertainty impacts the total number of players willing to take that risk at that point of time. If you have more definitive certainty, you have lower interest rates, you're going to see more expensive, you're going to see a higher exit value. But the number of exits, primarily whether they go up or down, or the dollar value of exits that are going up and down, are based on where the market wants to price things and where the sellers want to sell.
One of the things I think is interesting, and I agree with that. I think one of the things that's interesting is we're seeing way more exits coming out of emerging markets in a way that didn't exist as much. And 3 years ago,
one of the that's because of pricing in emerging markets is far more sensible.
No, I think that's
essentially you can, for example, when you're buying a company in Europe, you're buying it for an EBITDA multiple, where if you're buying it for 6 to 8 times, you feel like you're making enough returns with enough of a buffer of a risk. If you're basically looking at a high growth company in the US, you might be paying a lot more. And so you're like, maybe if I don't understand the risk, I need to pause.
I think that's part of it. I think there's also just a supply. We're now seeing a real supply of companies at scale. 3 years ago, Nubank was 4 years ago, Nubank was one of the biggest IPOs. 2 years ago, the largest M&A in the world up until December was Pismo in Brazil. We're starting to see real companies that are globally relevant and globally of revenue size that I think we're going to see more. And I think as market analysts and infrastructure gets more comfortable with that, I think we're going to actually see much more liquidity possibilities.
The largest tech IPO was from this region in 2024, Talabat.
Yeah, for sure,
so
exactly.
So this region was started to see it a bit more, for sure. What about strategic buyers? Still on the topic of exits, do you think they're becoming a bit more politically constrained in this environment, or are you seeing more different types of cross-border capital flows because of that sort of reshaping that?
My take in emerging markets, there have not been that many. The arc of M&A of big tech companies in emerging markets still the data points are more limited. I think geopolitical tensions for sure are an issue. I actually just think we need more companies getting to that size. We're starting to see global buyers buy local companies in a bunch of markets we're operating in. I also think it's early days. I think we're going to have way more kind of data points of this.
I think the big companies will continue to buy. At the end of the day, as the company gets to a certain size, eventually it's more about financial management and financial discipline and financial scale than, and so they'll continue to do it. The non-tariff barriers that we spoke about earlier were adding constraint layers. For example, when with Lina Khan a couple of years ago. You just had to slow down if you're a tech company and you're not able to buy many things. Then the tech companies started getting around it by basically not buying the company, but buying all the people, as we saw with a couple of acquisitions in AI both by Microsoft and Google. So I think the large companies keep figuring out how to get around some of those barriers. I don't think it's decreased in terms of total M&A, and the volume of cash that they're holding keeps increasing, so you're only going to see more. I don't think you're going to see less.
So we're almost, well, not almost, but we've got a few minutes left. I want to ask a few closing questions. So first of all, one piece of advice you'd give founders building in a more fragmented world?
Maybe two thoughts. I think one, as you build your cap table as a founder, figure out ways to build the right set of relationships. If your business model depends on cross-border type things, bring some of that expertise on. If you're a fintech that needs a link to regulatory bodies, bring some of that expertise on as advisors and investors or folks that are connected. I think that's one thing. And I think two, a founding team or a founder won't have every set of expertise. Build a team around you that can complement and supplement different aspects of that. I think that is in many ways the best assets you can build.
There's lots of stuff you can think about that will help founders, but I think your question was focused on in the fragmented world. So I'd say don't change your ambition. Your ambition as a startup or as a new founder should always be global and big. How you do it now changes a little bit in terms of what do you know best, build that. Build for a market you know best, start there. Keep it as local as possible. Once you basically build for that, it's the easiest step. Then by that time, keep adding on a management layer that can help you replicate that in other locations. And that's how I think it should be done.
And now protectionism. Is it net positive or net negative for innovation?
Net negative for speed and execution. Net positive in a few areas because if you're given unlimited resources, you don't always come up with the best solution. If you're given unlimited options, you get lazy. Constraints allow for the highest level of creativity. And so you will see that to be a positive in terms of protectionism. And like I said earlier, when I was younger, I would say protectionism is bullshit. We should never have it anywhere. And now I'm like, if you are a long-term thinker within any country, strategic protectionism is an absolute must, and you have to figure out what industries you need within that are local and that will build locally, that no matter what happens, you are protected in some form.
I agree with that. And I think it also just depends on who the audience is. If it's for a founder that's just starting today, figure out where protectionism can be the asset for you, or the thing you want to build. And then, if it's really impacting your business, figure out how to build resiliency and efficiency, controlling your destiny as much as possible.
Okay, so final question. Looking ahead 5 years, do you think startups will be more global or more regional? I think we've kind of covered it, but...
I believe there's going to be two different types of companies. There's going to be a certain set of companies that have global network effects, think like the AI models, biotech, hardware. Those will continue to be global. I think there's going to continue being global network effects. But I think there's going to be in a lot of big industries, financial services, healthcare, commerce infra, many places I invest in, much more localization and much earlier. I think we're going to see that. That's a trend that's already happening, and I think will accelerate.
I think if you're a startup founder, eventually you should always figure out how to be global, because why limit your markets in any form? All today's environment means is you'll have to invest more locally to feel more local and be more local because of the non-tariff barriers like, hey, we need the data to basically be hosted locally. We need the data centers to be hosted locally. We need the local regulations to apply. We need money movement to have might have more constraints. You'll have to still be local around it. So I think as a startup founder, the ambition should be global. The implementation will be more and more local with more local teams.
Well, thank you very much. This is all we have time for. Thank you so much to our panelists. Please a round of applause.